Forget the retail noise. While timelines are clogged with memecoin theatrics, chart battles, and breathless predictions about the next bull run, something far more consequential and far more permanent is taking shape quietly in the background. It's not happening on the front page of crypto Twitter, and it's not being driven by influencers chasing engagement. This is institutional finance's next infrastructure shift, and XDC, XINFIN, is right at the heart of it. XDC isn't chasing hype cycles. It's not here to win Twitter polls or trend for a week. It's building the rails for the next era of institutional tokenization, the kind of adoption that doesn't collapse in a bear market because it isn't reliant on speculative hype. This is adoption that gets woven directly into the very systems banks, asset managers, clearing houses, and regulators rely on every single day. And here's the thing most people miss. This isn't theory. This isn't what-if white papers or half-baked proof of concepts. This is real-world deployment happening now. We're talking about regulated tokenized securities that comply with jurisdictional laws. Institutional funds being wrapped into blockchain-native instruments that still meet every compliance check. Commodity-backed tokens tied to legally recognized warehouse receipts. Real estate asset wrappers structured to move through existing legal channels without breaking them. Every piece of it is built with legal clarity baked in. Custody solutions aren't an afterthought, they're enterprise-grade from day one, designed for the same institutional vaults and custodians that safeguard billions in traditional markets. Compliance isn't a box to tick at the end. It's the cornerstone of every deployment. And AML/KYC isn't some optional process. It's an integrated pipeline capable of meeting the highest levels of regulatory scrutiny, whether the asset is moving between institutions in New York, London, Dubai, or Singapore. Why does this matter so much? Because in the trillion-dollar world of institutional finance, the real bottleneck has never been the technology. Blockchains have been fast and scalable for years. The real bottleneck has always been trust. Trust in legal enforceability, trust in compliance, trust in counterparties, and trust in the security of the underlying system. XDC is solving that bottleneck by ticking every institutional box. Security, legality, interoperability, and regulatory comfort. This is why you're not seeing the noise. Because the institutions that matter aren't looking to broadcast every move. They're quietly plugging into the rails that will carry trillions in tokenized assets over the next decade. XDC is becoming the financial plumbing for a tokenized future while the rest of the market is still debating whether the pipes should be made of plastic or steel. If you want to see where real tokenization, the regulated institution-ready kind, is actually going to happen, if you want to understand why banks, asset managers, sovereign wealth funds, and clearing houses are already testing, integrating, and in some cases launching products on XDC, then stick around. By the end of this breakdown, you won't just understand why XDC is becoming the go-to for institutional tokenization. You'll see the structural shift it represents, and why this moment will be remembered as the quiet start of something massive. Tap that like button. Share this with someone who still thinks tokenization is 5 years away. And let's get into the legal, security, and compliance machinery that's making this all possible. When institutions move, they don't move on sentiment, they move on certainty. And in the world of blockchain, certainty has always been a rare commodity. Retail traders can hop on a new chain because it's fast or cheap, but a bank, a sovereign wealth fund, or a Fortune 500 asset manager needs something far more concrete. Enforceable legal clarity that holds up in court, in multiple jurisdictions, and under multiple regulatory regimes. This is where XDC's approach stands apart. Instead of trying to convince institutions to adapt to blockchain's anarchic rules, it's been quietly embedding blockchain functionality inside the guardrails institutions already trust. Existing securities laws, international trade finance standards, and ISO 20022 messaging compliance. That means when an asset is tokenized on XDC, it isn't just a digital representation floating in cyberspace. It's a legally recognized instrument tied to real-world rights and obligations, enforceable from London to Dubai to Singapore. For traditional finance, that's not just a nice-to-have. It's the only way they'll commit capital. A tokenized bond on XDC isn't some novelty. It's issued under actual securities law with disclosures, investor protections, and recourse mechanisms baked in. A commodity-backed token isn't a speculative wrapper. It comes with verifiable custody agreements, licensed custodians, and legal recourse for breach. This isn't about decentralization purity tests. It's about institutional pragmatism. If a platform can't pass the regulatory smell test in New York, Frankfurt, or Hong Kong, it will never see serious adoption beyond crypto Twitter. XDC has been quietly ticking those boxes from day one, aligning with recognized legal structures so that tokenized assets can be treated like any other compliant security or trade instrument. And here's the kicker. Because XDC is a hybrid blockchain, institutions don't have to choose between public transparency and private confidentiality. They can operate in permissioned environments with compliance controls and tap into public network benefits when needed, all without breaching the legal frameworks that govern them. In short, XDC isn't asking institutions to gamble on a new legal paradigm. It's offering them a blockchain that already fits the one they operate in, and that's why it's becoming the first port of call for regulated tokenization. Security that meets enterprise-grade and regulator-grade standards. In institutional finance, security isn't just about keeping hackers out. It's about safeguarding billions in value, meeting strict operational standards, and maintaining provable compliance for every single transaction. For retail users, a breach is a nightmare. For a bank, asset manager, or sovereign fund, it's an existential risk. One compromised transaction can mean lawsuits, regulatory sanctions, loss of licenses, and in some cases, collapse of public trust. That's why institutions don't adopt platforms based on hype cycles. They choose platforms that are engineered for fortress-level resilience. XDC's architecture was designed with this reality in mind. Instead of relying solely on generic blockchain immutability, it layers multiple lines of defense, cryptographic security, permissioned access controls, enterprise-grade node management, and compliance monitoring into a single hybrid framework. That means assets aren't just safe from unauthorized tampering. They're also safe from operational errors, custody mismanagement, and regulatory blind spots. Key institutional security elements. Hybrid privacy controls. Institutions can operate private, permissioned subnetworks for sensitive transactions, e.g., high-value bond issuance, while still leveraging XDC's public chain for settlement finality. This dual approach ensures transparency for regulators and auditors while protecting competitive or sensitive deal data. Custody-grade key management. XDC supports integration with licensed custodians, multi-signature authorization, and hardware security modules, HSMs. The same tools Tier 1 banks use to protect trillions in traditional assets. This eliminates the single point of failure risk that plagues many blockchain projects. Real-time compliance monitoring. The network can embed KYC/AML checks and enforce asset-level restrictions directly in the smart contract layer. This means that if a tokenized security is only legally tradable among accredited investors, the network itself enforces it, no manual oversight needed. Regulatory-ready audit trails. Every transaction is recorded in a format that aligns with existing audit and reporting standards, allowing institutions to provide regulators with verifiable, time-stamped records without expensive post-hoc reconciliation. This is not the move fast and break things mindset of early blockchain experiments. It's the opposite. Move securely, integrate seamlessly, and prove compliance before onboarding capital. And here's why that matters. In institutional adoption, security is the foundation of trust. A fast blockchain with no proven security model is a liability. But a blockchain that offers security designed to satisfy both internal risk committees and external regulators, that's a green light for billion-dollar asset flows. With XDC, the security conversation doesn't end at "we use encryption." It extends to how encryption, custody, permissions, and compliance checks work together, not as optional features, but as core infrastructure. That's why banks, asset tokenization platforms, and even trade finance consortia are quietly building here. From necessary burden to strategic advantage. In the world of institutional finance, compliance has never been optional. It's the invisible scaffolding holding the entire market together. The reason you can wire millions across borders, trade regulated securities, or settle derivatives without a second thought. For decades, that scaffolding has been expensive, slow, and fragmented. Every country has its own rules, every market its own regulators, and every transaction its own pile of paperwork. For blockchain projects, Compliance is usually treated as a bolt-on, a layer they'll figure out later once adoption scales. But that approach instantly disqualifies them from the institutional conversation. A project without a clear compliance framework isn't just inconvenient for a bank. It's legally toxic. XDC took the opposite path. From day one, its architecture and governance were built with regulatory interoperability as a core design principle. Not just can we handle compliance, but can we make compliance easier than in the traditional system? 1. ISO 20022 alignment, speaking the language of banks. ISO 20022 isn't a marketing buzzword. It's the global standard for financial messaging. Every major clearinghouse, payment network, and regulatory body is shifting to it. By natively supporting ISO 20022 messaging formats, XDC makes it natively compatible with the Rails institutions already use. This means tokenized assets, payments, and trade finance documents can move across XDC and slot directly into a bank's existing back office without custom integration nightmares. It's like showing up to an international business meeting already fluent in the language everyone speaks. Trust is established before you've even pitched. 2. Asset-level regulatory controls. With XDC, compliance isn't a single network rule, it's granular, asset by asset. A tokenized real estate security in Singapore can carry embedded rules that restrict trading only to licensed REIT investors under MAS regulations, while a European green bond on the same network can enforce EU taxonomy compliance and disclosure requirements. This isn't theoretical, it's programmable. It means XDC can host multiple regulated asset classes in multiple jurisdictions simultaneously without creating regulatory collisions. 3. Instant, auditable reporting. In the traditional world, compliance reporting is reactive. Regulators request records, institutions scramble to compile them, and weeks of reconciliation follow. On XDC, every transaction is already timestamped, categorized, and exportable in regulator-ready formats. For a compliance officer, this turns a historically slow, stressful process into a near-instant click-and-send workflow. For regulators, it creates real-time visibility without needing to trust. They can verify directly. 4. Cross-border regulatory bridges. One of the biggest barriers to institutional tokenization is regulatory fragmentation. What's legal in one country might be restricted in another. XDC's hybrid architecture and standards-based approach make it possible to layer jurisdiction-specific compliance frameworks on top of the same asset. In practice, that means a tokenized supply chain instrument can meet EU anti-money laundering rules, Singapore securities guidelines, and US FinCEN reporting standards all at once, without duplicating infrastructure. 5. Compliance as a market differentiator. Most retail traders hear compliance and think slowed growth. Institutions hear compliance and think risk eliminated. When an asset manager can tell clients, we can prove regulatory conformity in every trade. We can audit transactions instantly. We can integrate directly into SWIFT, RTGS, and other core rails. It becomes a selling point, not a limitation. This is why compliance-first architecture is not a bottleneck. It's a catalyst. It's the reason institutional pilots on XDC are scaling to full production, while other projects remain stuck in sandbox mode. The truth is, institutional adoption doesn't happen because of speed alone, or low fees, or even scalability. It happens when all of those things are packaged in a system that regulators approve, compliance officers trust, and integration teams can plug into without ripping out their existing systems. And that's where XDC isn't just another blockchain option. It's the one that already speaks the legal, technical, and operational language of the financial world. The institutional bet on XDC. Why the smart money is quietly positioning. Institutional adoption doesn't look like retail FOMO. There are no Discord pumps, no moon tweets, no rapid-fire price predictions. Instead, it's slow, deliberate, and almost boring on the surface until you realize what's being built. And in the case of XDC, that quiet, methodical activity is exactly why it's winning in spaces where hype coins don't even get invited to the table. Here's the institutional mindset. They don't gamble on untested tech, they don't risk reputations on compliance gray zones, and they don't onboard platforms without knowing every legal clause and technical contingency. When you see a bank or sovereign wealth fund deploy on a blockchain, it's not because they like the community. It's because that network checks every operational, legal, and reputational box they have. And right now, XDC is checking those boxes one by one. Not with noise, but with signatures on enterprise contracts. Not with promises, but with live, regulated asset issuances. From tokenized green bonds for infrastructure development to real estate-backed securities, from trade finance instruments to gold and commodity-linked tokens, XDC's rails are being embedded into workflows where trillions move, workflows that cannot afford downtime, hacks, or legal uncertainty. The thing about this kind of adoption is that by the time the public notices, it's already too late to get in early. Institutional tokenization isn't viral, it's structural. The deals are signed behind closed doors, the systems integrate in pilot phases, and then, seemingly overnight, the flow of assets on-chain becomes a permanent part of the market's plumbing. By that point, the infrastructure is locked in for decades, not months. XDC's advantage isn't just technology. Plenty of blockchains can claim speed and low fees. Its advantage is trust, a hard-earned trust built on legal enforceability, compliance readiness, and a governance model institutions can actually interact with. When regulators knock, XDC-based solutions can answer with documentation, not excuses. When custody is needed, regulated partners are already in place. When interoperability matters, XDC bridges into existing financial rails without breaking their risk protocols. For institutional tokenization, that's the winning formula. And while retail traders keep cycling between boom and bust narratives, XDC is laying track for a train that will carry not just the next bull run, but the next generation of the global financial system. Right now, most of the crypto conversation is stuck in the same loop: price targets, next altcoin pumps, speculation on which chain will dominate retail narratives. But history shows that true financial revolutions don't start with retail hype. They start with institutions quietly shifting infrastructure under the surface. And by the time the public realizes it, the system has already changed. That's exactly what's happening with XDC. The average person will notice it late, maybe when their bank starts offering tokenized bonds powered by blockchain, or when their investment portfolio contains digital securities that settle in seconds instead of days. They won't even think about the rails making it possible. But the institutions deploying billions right now, they know those rails are XDC. They know the legal frameworks are in place. They know the compliance story is airtight. And here's the truth. When the rails are set, you don't get to swap them out easily. Financial infrastructure is like the foundation of a skyscraper. You don't rebuild it every few years. You build it once and everything else rises on top. That means the institutional bet on XDC isn't just a market cycle play. It's a decades-long commitment baked into the core of how assets will move, trade, and settle worldwide. This is the part of the story where most people still underestimate it. They think blockchain adoption means merchants accepting crypto at the checkout. But in reality, the bigger wave, the trillion-dollar wave, is happening behind closed doors, in boardrooms, in compliance offices, in regulator sign-offs. And it's being built on networks like XDC, where security, legal clarity, and institutional-grade design aren't features. They're the entire reason the network exists. So you have a choice. You can wait until this is front-page news and everyone's talking about it, or you can start paying attention now when the foundations are still being set. Because by the time the public sees what's been built, the opportunity to position yourself won't be early anymore. If you found this breakdown useful, hit like, drop your thoughts in the comments, share it with someone who still thinks blockchain is just for crypto traders, and subscribe so you don't miss the next deep dive into the infrastructure quietly shaping the future of finance. This isn't about hype. This is about watching history get written and making sure you're on the right side of it.